It is January 28th, 2026. The S&P 500 just crossed 7,000 for the first time in history. My investment app is throwing confetti, but my grocery receipt, it's throwing hands.
You're looking at the wrong number. The Bureau of Labor Statistics says headline CPI in December 2025 was up 2.7% from a year earlier. Technically, inflation is behaving.
Behaving? Look at line 4. Coffee. Nationally, it's been a double-digit climber. My usual brand is up nearly 20%. And ground beef in my store is up something like 15%. If this is behaving, I can't afford it.
That is the friction of a pivot. You want a reindustrialized America? You want to stop relying on cheap imports? This is what the detox looks like.
It is also what a specific basket looks like. Food at home was up 2.4% over the year through December 2025. But averages don't drink coffee or grill steaks. If your cart is heavy on the items that spiked, your personal inflation rate won't feel like 2.7%.
So the market is at an all-time high because investors are betting on the future. But I'm paying for dinner today. Eggs got meaningfully cheaper late last year. Great. But the steak next to them still feels like a luxury item.
Think about the strategy shift. Biden tried to fix the economy by changing what we build. Chips, batteries. That takes years. Trump is trying to fix it by changing who we trade with. That hits prices quickly. The 10% baseline tariff was announced in early April 2025 and took effect that same month. We knew this would show up at the register.
Both strategies have a cost. One puts debt on the national credit card. The other functions like a tax on your debit card. Markets can ride the story. Households just feel the squeeze.
That is the question for tonight. We are stripping away the campaign slogans. We aren't doing vibes. We are doing receipts. Welcome to the ledger.
Let's be precise about what inflation is down actually means. It does not mean prices came back down. It means the rate of price increases slowed.
Thank you, because when I hear inflation fell into the 3% range, I expect my grocery bill to shrink. It hasn't.
And it won't, absent actual deflation. Here is the auditor's math. From January 2021 to January 2025, the overall CPI price level rose about 21%.
21% in 4 years.
Correct. And in that same window, average hourly earnings rose about 20%. So, after inflation, the typical worker's buying power was roughly flat to slightly down. You ran a marathon just to stay in the same place.
But look at why prices rose. That matters. The inflation peak in June 2022, 9.1% year over year, was driven heavily by disrupted supply chains and a global energy shock.
He's right about the mix. In June 2022, the energy index was up 41.6% year over year, and gasoline was up 59.9%. That's not a vibe. That's a real-world squeeze.
Exactly. We were vulnerable. We were addicted to frictionless supply chains and cheap energy. When the world broke, we paid for it. The pivot in 2025 wasn't about fixing the price of eggs overnight. It was about reducing the risk of another single point of failure shock.
Okay, but we are in January 2026 now. Energy isn't doing what it did in 2022. So why is inflation still stuck around 3%?
Because the source changed. The sticky inflation now isn't mainly gas. It's services and shelter. In December 2025, shelter was the biggest factor in the monthly CPI increase. Rents and housing services move slowly. They're heavy. They don't spike and crash like oil. They grind.
And yes, there is a policy cost. We have to be honest about that. The tariffs.
The 10% baseline tariff.
The additional 10% duty that started in early April 2025, plus the higher reciprocal rates that rolled in after that and then got modified. Depending on how you count it, Yale's Budget Lab puts the overall effective rate in the mid to high teens. That is a cost. But it is a feature, not a bug. We are forcing companies to build here. If they want to import, they pay a premium. That premium can push some prices up at first, but it also changes where investment goes.
Let's look at the receipt. Research on the 2018-2019 trade war found tariffs were passed through almost completely at the border. Retail is messier, but the incidence largely lands here. It's a tax. You can call it an industrial policy, but for a shopper, it shows up as a more expensive toaster.
Or coffee. My coffee and tea category is up about 11% this year.
In December 2025 CPI, beverage materials including coffee and tea was up 11.8% year over year, and coffee itself was up roughly 20%. That's not all tariffs, but trade costs can stack on top of real supply issues.
But look at the core goods. The pass-through has been gradual. Companies are eating some margins to keep market share. It hasn't been the instant 10% spike the doomers predicted.
That's fair. The timing looks slower. But there is a giant asterisk on this whole stretch of data. We are flying partially blind.
What do you mean?
The federal government shutdown that started October 1, 2025. The Bureau of Labor Statistics couldn't do normal CPI survey collection for October, so we don't have a clean month in the ledger. October is missing in many CPI tables, and BLS had to use carry-forward methods and publish around the gap. When we say inflation is stabilizing around 2.7%, we should remember the monthly path has a scar through late 2025.
So, Biden gave us a 9% shock that cooled off but left prices about 21% higher. Trump is giving us a sticky 3%, driven by rent, services and tariffs, and we even have a data gap in the middle of it.
That is the audit. You traded a supply shock for slower moving pressures. The rate is lower, but the price level reset is real.
Biden used carrots. Trump is using a sledgehammer. That's the fundamental shift we watched happen in 2025. For 4 years, the strategy was industrial policy, massive subsidies, tax credits, and loans to lure factories back. And if you look at the raw construction spending data, it really does look like a miracle. Look at that curve. Manufacturing construction spending was about $76.5 billion annual rate in January 2021. By mid-2024, it peaked around $240 billion. That is not a rounding error. That is a boom.
It's a boom in concrete, expert, not automatically a boom in chips. You have to distinguish between construction put in place and actual factory output. Yes, chips and clean energy incentives poured fuel on the build-out. But by the time Biden left office in January 2025, how many of those mega projects were actually shipping meaningful volume?
That's the question. I saw the headlines. Intel coming to Ohio. TSMC in Arizona. Did those jobs actually show up? Or are we just staring at expensive shells?
The shells are real, but the timelines are slipping. Take Intel in Ohio. The original pitch was chips in the mid-2020s. Now the first fab is projected to be completed in 2030 and operational in 2030 or 2031. It turns out you can write a check, but you cannot print skilled labor or force complex equipment to arrive on time. The carrot strategy built a massive pipeline, yes, but it's clogged.
Which is exactly why the pivot to the wall strategy in 2025 was necessary. The carrot wasn't working fast enough, so Trump applied the stick. A 10% baseline reciprocal tariff layered on imports, with higher rates for certain partners, plus bigger Section 232 metal tariffs that hit input costs directly. The logic is brutal but simple. If importing gets expensive enough, you either build here or you eat the margin.
Okay, but did it work? Did the wall force them to open the factories faster, or did they just panic?
They hesitated. Look at the Dodge Construction Network updates in 2025. Manufacturing starts were a roller coaster, and the longer-run comparisons were down. That's what uncertainty does to capital. If you're a CEO and tariff rates are lurching 25% to 50% on metals, new country-by-country duties, maybe you don't break ground on a billion-dollar plant. You wait.
It's not a freeze. It's a recalibration. Yes, there's friction. When steel and aluminum tariffs jump, construction costs go up. That hurts. But we did see wins. Real ones.
Name one. Give me a ribbon cutting.
Hyundai. The Meta plant in Georgia. They held the grand opening on March 26, 2025. It's a massive facility. Real floor space, real hiring, real supply chain commitments. It proves the build-out can finish. But it also proves the point. This isn't instant, and it isn't just one lever.
That project started under the earlier incentives. You can't credit 2025 tariffs for a plant that broke ground years ago. And look at the other side of the ledger. GM and its Ultium battery venture have had to adjust. Slower EV demand, shifting plans, and job impacts rolling into 2026.
So the scoreboard is mixed. We have a few grand openings, a lot of delayed megaprojects, and a construction sector that is terrified of the price of steel.
We are transitioning from an economy addicted to cheap imports to one that builds its own capacity. That transition is painful. It looks like chaos. But the empty shells, you see, those are the assets of the next decade. The tariffs are just the pressure, one kind of pressure, trying to fill.
Or they're the tax that makes filling them too expensive to afford.
Great. So I might get a factory job in 2030, but I'm paying for the steel tariff in my car payment today. Speaking of payments, let's talk about the people who actually have to work in this economy. Who got hired and who got deported? If you worked for tips or overtime in 2025, you probably noticed the new tax break. Not tax-free, but lighter on the federal income tax side. But if you tried to hire a contractor to fix your roof, or just watched prices jump when workplaces and supply chains got disrupted, you felt something else entirely. This was the year the labour market pulled in two directions at once. A tax break on certain kinds of work, and a shock to the workforce itself.
It wasn't a paradox. It was a deliberate shift. The One Big, Beautiful Bill Act leaned into a simple message. Reward work. Stop penalizing extra effort.
Let's keep the fine print straight. No tax on tips is a federal income tax deduction, not a blanket exemption. It's up to $25,000 a year, and it starts phasing out once your income gets high enough. If you already owe zero federal income tax, a deduction can be worth zero. And you still owe payroll taxes.
Okay, but for the bartender making decent money, that's real cash. What about the overtime piece? I heard guys on the factory floor saying their overtime was tax-free.
Not quite. The overtime provision is also a deduction, and it applies only to the premium portion. The half in time and a half for overtime required under federal rules. It's capped at $12,500 a year for a single filer. Helpful, yes. A tax holiday, no.
And it's not just symbolism. It's a signal that domestic labor has leverage again. That's the other side of the coin. Enforcement got dramatically more aggressive in 2025, with internal pressure to hit numbers like 3,000 immigration arrests a day. The politics were harsh, But the argument was that it restores bargaining power for U.S. workers.
Harsh is a polite way to put it. We saw headlines about daily arrest targets in the thousands. And I remember the Omaha case. A food packaging plant gets raided in June 2025. More than 70 workers arrested, and suddenly the plant is running at around 30% capacity.
And that disruption didn't stay in Omaha. It showed up in production schedules and on grocery shelves. That's what happens when you remove labor quickly. You get a supply shock. The administration even tried a brief mid-June pause, telling ICE to back off farms, hotels, restaurants, and meatpacking. Then, days later, the guidance got yanked back. That whiplash is the story.
That pause was a tactical wobble, not a strategy change. You can't turn the ship overnight without breaking a few dishes.
We broke more than dishes. We broke the housing market's ability to build on schedule. In an AGC NCCER survey in 2025, 45% of firms said labour shortages were delaying projects, and separate industry estimates said construction needed roughly 439,000 net new workers in 2025 just to keep up.
Exactly. This is where the consumer audit turns red. You might save money from a deduction on overtime or tips, but if labour disruptions and shortages push up construction costs, slow new apartments, and squeeze supply, your rent, your remodel, your home price is where you feel it.
You're assuming those costs are permanent. They aren't. When pay rises and firms invest in training, more workers come in. It's messy, but markets do adjust.
But do they adjust in time for monthly bills? That's the mixed bag. For tipped workers and some shift workers, 2025 could mean a lower federal income tax bill. For everyone else, the enforcement shock and shortages showed up as higher costs and longer waits. Giving with one hand, taking with the other.
If you want to see where both administrations missed the median voter, look at housing. It's the single biggest line item in the American household budget. And right now, it's trapped. A pincer movement between elevated rates, high prices, and a supply shortage that neither demand-side credits nor supply-side rhetoric has fixed at scale.
I just want to know one thing. In early January 2021, my brother locked in a 30-year fixed mortgage at 2.65%. It was basically free money. Now, I check the app and it says 6.09%. Why can't the president just force the Fed to cut rates and bring the 3% dream back?
Because 2.65% wasn't normal. It was a unicorn, an emergency-era rate that showed up in a crisis window.
Also, the president doesn't set your mortgage rate, and the Fed doesn't set it directly either. Mortgage rates tend to move with longer-term market rates, often proxied by the 10-year Treasury, plus a spread for mortgage-backed securities, servicing, and risk.
Exactly. Here's the basic math for late January 2026. The Fed's effective short-term rate is about 3.6%, but the 10-year Treasury is around 4.2% to 4.3%. Add the mortgage market spread and lender pricing, and you land right around a 6.1% 30-year fixed.
Wait, if the Fed cut rates, why is the 10-year Treasury still so high?
Because the bond market isn't just pricing today, it's pricing the next decade. Inflation risk, growth risk, and yes, the deficit. Washington is running large deficits, and big deficit-increasing laws don't help. For example, the 2025 One Big Beautiful Bill was scored by budget analysts as adding trillions to deficits over the next decade. More Treasury supply and higher term premiums can keep long rates from falling as fast as the Fed.
And the White House disputes the most pessimistic scores, arguing growth will offset part of the cost. But I'll concede this. The bond market votes every day, and right now, it's voting for higher yields. Still, the real housing problem isn't just the rate, it's the lock-in effect.
The lock-in.
Think about your brother with that 2.65% mortgage. Is he going to sell his house to buy a new one at about 6%?
No way. He's never moving. His payment would jump for the same square footage.
Precisely. Roughly 70% of mortgage holders have a rate at or below 5%. They're glued to their homes. That means fewer listings. And when inventory stays tight, prices can stay high, even if demand cools. Meanwhile, most estimates still put the national housing shortage at around 4 million homes.
And that brings us to the receipt. The NAHB Wells Fargo Cost of Housing Index found that a median income family needed about 38% of its income just to cover the mortgage payment on a median-priced new home, well past the common 30% cost burden line.
So let me get this straight. The bond market keeps long rates from crashing, so rates won't magically snap back to 3%. And homeowners are sitting on cheap loans, so prices won't crash.
Correct. The 3% era was an anomaly. To get back there, you'd need a much lower 10-year yield and a tighter mortgage spread at the same time. Until then, the seller stays put, and the first-time buyer eats the squeeze.
Unless we build our way out of it. But with labor shortages and immigration enforcement adding uncertainty to construction crews and subcontractors, who's going to build the houses fast enough?
So, here is the final ledger. It is January 28, 2026. The S&P 500 has topped 7,000 for the first time. Inflation is running about 2.7% over the past year. On paper, the numbers look calm again. But we know the paper isn't the receipt.
If you own assets, you are winning. Period. If you have a 401k or a brokerage account, this kind of market has been a tailwind. Whatever you think about the politics, asset owners are generally wealthier today than they were in 2024.
But that is only one type of winner. The real audit shows the biggest winners weren't chosen by a ballot box. They were chosen by a calendar. If you locked in a mortgage before 2022, you're insulated. You're paying roughly 3%, while new borrowers are looking at rates around 6%.
And don't forget the paycheck winners. If you work for tips or overtime and you're under that $150,000 income cap, the new deductions for tips and qualified overtime can lift your after-tax income when you file.
Provided you can find a house to buy with it. That is the other side of the ledger. The losers are the people trying to get into the system. First-time buyers staring at roughly 6% mortgage rates, renters, and anyone whose basics are exposed to price spikes, like coffee and tea, and to tariff-sensitive imports.
That is the bottom line. One president chased a soft landing. The next is attempting a hard pivot. But the truth? Your personal economy didn't depend on who sat in the Oval Office. It depended on where you stood when the music stopped in 2022.